Michael Burry, the guy we all know from The Big Short, got lucky and made millions betting against the housing market, and it almost destroyed him. Meanwhile, there's a guy in Nebraska who's been beating the market for 60 years doing something so boring it would put you to sleep. And here's the thing nobody tells you. Burry's story is incredible, historic, the kind of thing that gets turned into a movie starring Christian Bale. But it's also the exception that proves the rule. For every Michael Burry, there are 10,000 people who try to make the hero play and lost everything. This isn't about whether Burry is brilliant. He obviously is. This is about whether you should try to be Michael Burry. And the answer is almost certainly no. Let me show you why the boring approach wins, why Hollywood is lying to you about how success actually works, and why the most profitable strategy in almost any field is the one that makes for the worst movie. So let's start with what actually happened to Michael Burry that the movie glossed over. In 2005, Burry became convinced the housing market was a bubble ready to burst. He spent months analyzing thousands of mortgage-backed securities, found the fault lines in the system, and made his bet. He was right. But here's what happened between being right and getting paid. For years, he watched his fund lose money every single month. His investors revolted. They called him crazy. They threatened lawsuits to get their money back. His marriage suffered. He developed a stress-related medical condition. The pressure was so intense that even though he was proven spectacularly right, he closed his fund to outside investors shortly after and said he never wanted to go through anything like that again. The movie shows you the victory lap. It doesn't show you the 700 days of psychological torture. Now contrast that with Warren Buffett's approach. Buffett's strategy is so simple it sounds stupid. Buy good companies, hold them for decades. Don't panic when the market drops, repeat. He's been doing this since the 1960s. His average annual return is around 20%. He's never had a year as good as Burry's big win. He's also never had to take anxiety medication because his investors wanted to destroy him. Buffett is worth over $100 billion. Burry is worth around $300 million, which is incredible, but it's a fraction of what the consistent approach generated. And this pattern shows up everywhere, not just investing. Look at fitness. Everyone wants the transformation story. Lose 50 pounds in 90 days. Get shredded with this one weird trick. The problem is those transformations usually come from extreme measures. Eating 1,200 calories a day, training 3 hours daily, taking every supplement known to science. And you know what happens 6 months later? They gain it all back because the approach was never sustainable. Meanwhile, the person who loses half a pound per week by making small adjustments to their diet and exercising 30 minutes a day, they're still fit 5 years later. They built habits instead of heroics. Same thing in business. We celebrate the startup that raises $100 million in venture capital and tries to change the world overnight. Most of them fail. Like 90% of them fail. But the boring company that grows 15% per year, reinvests profits, doesn't overextend, they're still around 20 years later, quietly dominating their market. The difference is that one makes for a great TechCrunch headline and the other doesn't. Here's what actually makes small, consistent wins so powerful. And it's not what you think. It's not just that they compound, although they do. It's that they're anti-fragile. That's a term from Nassim Taleb. It means they get stronger from disorder and stress. When your strategy depends on one big win, you're fragile. Everything has to go right. The timing has to be perfect. The market has to behave the way you predicted. Your nerves have to hold. One thing goes wrong, and the whole thing collapses. But when your strategy is based on small, consistent wins, you can absorb shocks. Market crashes? Doesn't matter. You're buying all the way down and all the way up. Miss a workout? Doesn't matter. You'll work out tomorrow. One project fails? Doesn't matter. You've got 50 other bets running. The small wins approach isn't just safer. It's actually more resilient in the long run. Let me tell you about a study from behavioral economics that really got my attention. Researchers looked at two groups of investors. Group A tried to time the market, getting in and out based on predictions about what would happen next. Group B just invested the same amount every month regardless of what the market was doing. Over 20 years, Group B beat Group A by an average of 3% per year. That doesn't sound like much, but when you compound it over 2 decades, Group B ended up with nearly 80% more money. Why? Because the first group was right sometimes and wrong sometimes, like everyone who tries to time the market. But their losses from being wrong wiped out their gains from being right. Group B was never right or wrong. They just showed up consistently. The first group spent way more time thinking about investing, researching, stressing out. The second group spent like 10 minutes a month moving money into their account. They won by doing less. This is the part that really gets me. The hero approach doesn't just lose more often. It also requires way more effort, more stress, more opportunity cost from all the time you spend trying to be the hero. You see this same pattern in every domain where we have good data. In writing, the authors who publish one book every couple years consistently for 20 years build way bigger audiences than the ones who disappear for a decade to write their magnum opus. Stephen King has published over 60 novels. He writes 2,000 words every single day, including Christmas. Is each individual book as groundbreaking as, Infinite Jest? Probably not. But he's also one of the best-selling authors in history, and David Foster Wallace published 3 novels in his entire career. In software development, companies that ship small updates continuously have fewer bugs and more stable products than companies that save everything up for one massive release. Google updates their search algorithm thousands of times per year with tiny tweaks. Each change is barely noticeable. Together, they've kept Google dominant for 25 years. In relationships, the couples who stay together aren't the ones who have grand romantic gestures all the time. They're the ones who do small things consistently. A kiss goodbye in the morning, asking about each other's day, saying thank you. It's boring. It's not movie material, but it's what actually works. Now, I know what you're thinking, but what about all the people who did make the big play and won? What about the entrepreneur who bet everything on their startup and became a billionaire? What about the athlete who came back from a devastating injury to win the championship? Those stories are real. They happen. But here's what you need to understand about them. First, survivorship bias. For every person who made the hero play and won, there are hundreds who made the hero play and lost everything. You just don't hear about them because failure doesn't make for good movies. The documentary isn't called The Big Short that went horribly wrong, and now I live in my sister's basement. Second, even when the hero play works, it often works because of consistent effort underneath. Michael Burry didn't just wake up one day and bet against housing. He spent years building his expertise, running his fund, developing his analytical skills. The big bet was the visible part, but it rested on a foundation of small, consistent work. When you actually study most overnight success stories, they took 10 years. The winning part is just the moment everyone else noticed. So why does consistency beat heroics at a mechanical level in trading? Let me break down 3 specific reasons that matter specifically when you have capital on the line. Reason 1, your edge is probably smaller than you think. Here's something most traders don't want to hear. Even if you have a genuine edge in the market, and most traders don't, it's probably worth somewhere between 51% and 55% win rate, or maybe a risk-reward ratio slightly in your favor. That edge doesn't express itself on any single trade. It expresses itself over hundreds of trades. This is why the best traders in the world talk about their process obsessively and barely mention individual wins. When you try to make your year on 1 or 2 hero trades, you're betting that your edge will show up exactly when you need it to. But edges don't work that way. They're probabilistic. You might have a great setup that loses 7 times in a row before it starts working. If you size too big on trades 1 through 3, you're out of the game before your edge ever shows up. The boring trader who risks 1% per trade on their consistent setup, they can withstand 10 losers in a row and still be in the game. That's not sexy, but means they're still around when their edge starts expressing itself. Reason 2, consistency builds pattern recognition. Heroics build hope. Every trade you take teaches your brain something. When you trade the same setups consistently, even when they're small, you're building a massive database in your unconscious mind. You start noticing subtle differences between the setups that work and the ones that don't. You develop intuition, which is really just pattern recognition that happens too fast for conscious thought. But this only works if you're taking enough trades to build the database. The trader making 2 or 3 massive hero plays per year. They're not building pattern recognition. They're just hoping. And here's the insidious part about hero trades. When they work, you learn the wrong lesson. You learn that your conviction was right, that you should trust your gut. Then you make another one, and it blows up, and you don't know why, because you didn't have enough repetitions to understand what actually makes your edge work. The consistent trader with 200 trades under their belt in the same setup, they know exactly which conditions make it work and which don't. They've paid their tuition in small losses instead of catastrophic ones. Reason 3. Small losses teach, big losses traumatize. This is the one that ruins more traders than anything else. When you take a small loss, 1% of your account, 2% even, it stings a bit, but you can shake it off. You can review what went wrong, adjust if needed, take the next trade. When you take a 20% or 30% loss because you sized up trying to be the hero, that does something to your psychology that's hard to come back from. Literally, your nervous system registers it as a threat. Your amygdala gets involved. You start making decisions from a fear state instead of a rational state. I've watched traders completely change their personality after one big loss. The aggressive trader becomes timid. They start second-guessing everything. They miss obvious setups because they're scared. Or they go the opposite direction and start revenge trading, trying to make it back quickly, which usually leads to more losses. The small, consistent losses teach you what doesn't work without breaking you psychologically. You stay in the optimal zone where you're engaged, but not traumatized. That's the only zone where you can actually improve as a trader. Here's what makes this especially hard for traders. The market itself is designed to reward drama. Think about it. Every time you check your P&L after a big position, you get a hit of adrenaline. Win or lose, there's intensity. Your heart rate goes up. You feel alive. That's your brain getting a drug hit from volatility. The consistent trader risking 1% per trade, there's no adrenaline. You put on the trade, you manage it according to your rules. It either works or doesn't. You move on. It's boring. And our brains are wired to interpret boring as not important. This creates a weird trap where bad trading feels more engaging than good trading. The gambler sizing 20% of their account on a trade feels like they're really in the game. The professional risking 1 to 2% per trade feels like they're not even trying. But check their account curves after a year. The gambler has had some incredible highs and some devastating lows, and they're probably down overall or blown up completely. The professional has this beautiful, steady upward curve that looks boring on any given day, but compounds into something massive over time. And here's the really insidious part. Social media and trading forums are filled with the gambler's wins. Nobody posts their consistent 1% gains. They post their 100% day or their 10-bagger options play. So you're constantly being shown that the hero approach is what success looks like when actually you're looking at survivorship bias in real time. So how do you actually implement this in your trading? How do you build consistency when everything about markets is pulling you toward big dramatic plays? Start with position sizing that makes individual trades feel almost meaningless. I'm serious. If you're feeling nervous or excited about a single trade, you're sizing too big. Your default risk per trade should be small enough that you could lose 10 in a row and still feel fine about your overall account. For most traders, this means 0.5% to 1% risk per trade. Maybe 2% if you're experienced and have a proven edge. I know this sounds conservative. You're probably thinking at 1% per trade, how am I ever going to make life-changing money? Here's the math. If you have a decent edge and trade consistently, you might average 2 to 3% per month on your account. That doesn't sound like much, but compounded, that's 26 to 40% per year. Do that for 5 years, and you've turned $10,000 into $30,000 to $50,000. Do it for 10 years, and you're looking at 6 figures from a small starting account. But more importantly, you're still in a game. The trader who sizes 10% per trade might have some monster months, but they also have the months where they give back everything and more. They're on the volatility roller coaster, and it's only a matter of time before they get bucked off. Second thing, have a trading plan that's so specific you could hand it to someone else and they'd know exactly what to do. This isn't optional. This is the difference between trading and gambling. Your plan should specify what setups you trade, what time frames you trade them on, how you enter, where you place your stop, where you take profit, how you size, what conditions would make you not take the trade. Write it down, every detail. Then your job as a trader isn't to be creative or to have conviction or to predict what happens next. Your job is to execute the plan. That's it. This does sound mechanical. The best traders I know describe their process as boring. They see their setup, they check their criteria, it either qualifies or it doesn't, they take the trade or they don't. There's no drama in the decision-making because the decision was already made when they wrote the plan. The hero traders? They're reading the tape and trusting their gut and having conviction, which really means they're making it up as they go and hoping for the best. Sometimes it works because they get lucky, but it's not a process that compounds. Here's the part that separates the traders who make it from the ones who blow up. Learning to be okay with boredom. Most traders can't handle it. They have a good setup that triggers once or twice a day, and that feels like not enough. So they start trading marginal setups. They start forcing trades because sitting on their hands feels like they're not really trading. But overtrading kills more accounts than bad strategy. You dilute your edge by taking trades that barely qualify. You increase your costs through commissions and spreads. You wear yourself out mentally trying to stay engaged with the market all day. The best traders I know spend most of their time doing nothing. They're waiting for their setup. When it appears, they execute. When it doesn't, they read a book or go to the gym or work on another project. They've made peace with the fact that their job isn't to trade constantly. Their job is to wait for their edge to present itself and then take advantage of it. This is psychologically brutal at first. You sit there watching charts and nothing qualifies, and you feel like you're wasting your time. Your brain is screaming at you to do something, make something happen, be more active. That voice is trying to get you to blow up your account. It's the same voice that makes people chase trades after they've missed the entry, or revenge trade after a loss, or size up because they feel like they need a big win to feel like a real trader. Learning to ignore that voice is maybe the most important skill in trading. And the only way to develop it is through repetition. Small trades, consistent process, boring execution. Do it enough times, and you stop needing the adrenaline. The process itself becomes satisfying. There's research on this from trading psychology that I find fascinating. They studied day traders over a 2-year period, tracking everything, their trades, their P&L, their behavior patterns. The traders who were still profitable after 2 years had one thing in common. They took fewer trades than the average trader. Not more, fewer. They weren't more active. They were more selective. The losing traders had the opposite pattern. They overtraded, especially after losses. They'd take a loss and immediately jump back in trying to make it back. Or they'd have a winning day and keep trading to run it up more. They couldn't sit still. The winning traders? They had this almost eerie patience. They'd take a loss, review it, and then just wait for the next setup. Sometimes that meant not trading for the rest of the day. They were okay with that because they understood they were playing a long game. Here's the specific number that stuck with me. The consistent winners averaged 3 to 5 trades per day. The consistent losers averaged 15 to 20 trades per day. Both groups thought they were being active and engaged. But one group was executing a process and the other was gambling. And before you think, well, maybe the losers just had worse strategies, the researchers controlled for that. They looked at traders using similar strategies. The ones who traded it less frequently did better, just by being more selective and letting better setups develop. Let's go back to Michael Burry for a second, because I think his story actually proves the point in an unexpected way. Yes, he made a massive bet against the housing market. Yes, it paid off spectacularly. But here's what most people don't know. Before that trade, Burry had spent years building his fund through consistent, unglamorous stock picking. He was good at fundamental analysis. He showed up every day and did the work of reading financial statements, modeling companies, making careful investments. The Big Short wasn't him suddenly getting lucky or taking a random gamble. It was him applying the same consistent analytical approach he'd always used to a different asset class. The drama was in the scale and the timing, not in the method. And after the trade, he went back to basically the same approach: careful analysis, patient investing, nothing heroic. Because that's what actually worked for him. The big moment was an outlier in a career defined by consistency. The movie made it seem like his whole career was that one trade. In reality, that one trade was an exception in a career of consistent, methodical work. Hollywood edited out all the boring parts, which were 99% of what he actually did. This is the ultimate irony. Even the heroes aren't really heroes. They're consistent performers who had one dramatic moment that got all the attention. There's something deeper going on here that I think matters for anyone trying to make it as a trader. The hero narrative is seductive because it tells us we can overcome our circumstances through one extraordinary insight. That we just need to figure out the right trade, the perfect setup, the market call that changes everything. But trading doesn't work that way. There is no perfect trade. Every setup can lose. Every strategy goes through drawdowns. The edge is in the aggregate, not the individual. This is actually liberating once you accept it. You stop putting so much pressure on each individual trade to be the one. You stop trying to hit home runs. You just execute your process and let probability do its thing over hundreds of repetitions. The traders who can't accept this stay stuck forever. They're always looking for the holy grail strategy, the perfect indicator, the one technique that will make them rich. They jump from approach to approach, never sticking with anything long enough to develop real competence. And I get it. The boring, consistent approach feels like settling, like you're admitting you can't be special. But here's the thing. Consistency in trading is special. The ability to execute the same process for months and years without getting bored or impatient or greedy. That's incredibly rare. Most people literally cannot do it. Their psychology won't let them. They need the excitement, the drama, the possibility of the big score. So they keep gambling. The ones who make it are the ones who realize that trading is a business, not an adventure. You're trying to extract consistent profits from market inefficiencies, not prove how smart you are or have some legendary story to tell. And businesses succeed through systems and consistency, not through heroics. Let me give you some examples from trading specifically that show this principle in action. There's a prop trader I follow who trades one setup. Literally one. It's a specific type of mean reversion pattern on equity indexes. He's been trading it for 12 years. He takes maybe 2 to 3 trades per day. When it shows up, risks 1% per trade. Targets 2 are to 3 are. His returns? Somewhere around 30 to 40% per year consistently. Not flashy. But he started with $50,000 8 years ago, and now he's managing over $500,000 of the firm's capital and keeping a percentage of the profits. He's making comfortable 6 figures trading one boring setup repeatedly. Compare that to the guy who shows up in trading Discord servers with a different strategy every month. This month, it's crypto scalping. Last month, it was options. Before that, it was Forex. He's been at it for 5 years, and his account is still roughly the same size because he keeps blowing up and restarting. He's learned nothing because he never stays with anything long enough to learn. Or look at the systematic traders, the quants. They develop a strategy, backtest it, and then they just run it. For years. They're not making discretionary decisions. They're not trying to outsmart the market on any given day. They're letting their edge express itself over thousands of trades. And you know what? The best systematic funds have been doing this for decades. Renaissance Technologies has been running variations of the same basic approach since the 1980s. They're not trying to call market crashes or pick the next Tesla. They're extracting small edges repeatedly, and it's made them one of the most successful hedge funds in history. Here's why this is harder for traders now than it's ever been. Trading has been gamified to feel like entertainment. Look at Robinhood, Webull, any of these apps. They send you push notifications when your stocks move. They have confetti animations when you make a trade. They show you what's trending, what's moving, what everyone else is buying. Everything about the interface is designed to make you trade more, not trade better. Crypto made this even worse. The ability to trade 24/7 with massive leverage, with extreme volatility, It's like they designed the perfect environment to destroy trader psychology. You could get a 50% move in an afternoon. You can lose everything in a liquidation. The emotional swings are massive. And social media shows you everyone's winners. The guy who made 1,000% on some altcoin. The person who nailed the short on Nvidia. The options player who turned $1,000 into $100,000. You never see their overall account curve, which is probably down massively because they blew up everything they made trying to do it again. This creates this toxic environment where consistent trading feels inadequate. You're making your 2 to 3% per month with controlled risk, and you see people claiming they made 50% in a week. It makes you question whether you're doing it wrong. But here's the reality. Most of those people give it all back and more. The screenshots are from the temporary winners, not the long-term survivors. And the platform wants you to feel like you're missing out because they make money when you trade, not when you make money. So what do you actually do about this? How do you build a consistent trading practice in a world that's constantly showing you get-rich-quick plays and overnight millionaires? First, kill your FOMO. Unfollow anyone who's primarily posting their P&L, especially if they're posting daily or weekly screenshots. That content is designed to make you feel like you're missing out, and FOMO is the enemy of good trading. Follow traders who post their process instead, who talk about their setups, their risk management, how they handle drawdowns, who've been doing this for 5+ years and are honest about how hard it is. The real traders aren't posting lumbos and watches. They're posting chart markups and discussing market structure. Second, set up your trading environment to support consistency, not gambling. This means actual practical stuff. Turn off push notifications from your broker. Don't keep a second monitor showing your P&L in real time. Set price alerts for your setups instead of watching charts all day. If you're prone to overtrading, put literal barriers in place. Some traders I know set up their platform so they can only take a maximum of 5 trades per day. Once they hit 5, the system locks them out. Sounds extreme, but if you're someone who takes 20 trades when stressed and 15 of them are garbage, that rule might save your account. Same with position sizing. If you keep sizing too big, write your maximum risk per trade in big letters and tape it to your monitor. Or set up your platform to automatically reject any order above a certain size. Remove the ability to make the mistake in the moment when your emotions are high. Third, and this is the mental shift that matters most, stop thinking of yourself as someone trying to get rich and start thinking of yourself as someone who trades professionally. Professionals have a process. They follow it. They don't deviate based on how they feel or because they saw something exciting. They treat it like a job. Show up, execute, log results, improve incrementally. Amateurs are trying to hit a home run. They're looking for the trade that changes everything. They'll blow up their account 3 times trying to catch lightning in a bottle because they're optimizing for the wrong thing. Every trade you take is a vote for the type of trader you are. Take a trade outside your plan. You voted for being an impulsive gambler. Stick to your rules during a drawdown. You voted for being a professional. Skip a marginal setup even though you're bored. You voted for being selective. You don't need every vote to go the right way. You just need the majority. And you build that majority through consistent repetition of good decisions, not through occasional brilliant trades. The brilliant trades will happen sometimes. Your edge will occasionally give you an amazing winner. But those aren't what make you profitable. What makes you profitable is that you didn't blow up your account during all the times when your edge wasn't expressing itself. I need to be honest about something. Even with the consistent approach, you're going to have brutal stretches as a trader. You'll have weeks where your setup doesn't work, where you take 5 losses in a row, all following your rules perfectly, where you watch other traders print money on trends you're not participating in because they're not your setup, where you start questioning whether your edge even exists. Those moments are when most traders abandon their process. They think, clearly this isn't working anymore, and they either quit or they start taking random trades trying to force something to happen. And that's usually when they blow up. But here's what actually happens during drawdowns if you're trading properly. You're gathering data. Every loss following your rules is information about when your edge doesn't work. If you keep stats, you'll start noticing patterns. Maybe your setup doesn't work well in low-volume environments, or during certain market regimes, or on specific days of the week. The consistent trader uses drawdowns to refine their process. The gambler uses drawdowns as an excuse to abandon their process. And here's the uncomfortable truth. Your edge might legitimately stop working someday. Market conditions change. Inefficiencies get arbitraged away. The strategy that worked for 5 years might stop working. That's just reality in trading. But if you've built a process around consistency, taking small risks, testing thoroughly, keeping good records, you'll notice when your edge deteriorates. You can adapt. You can develop new setups. You won't blow up because you're not risking 20% of your account on any single approach. The hero trader who made their year on one big call, when their moment of insight stops working, they're toast. They have no process to fall back on. They were right once, and they think that means they'll be right again. So they keep betting big, and eventually they lose everything. Here's my last thought on this, and it's the one that completely changed how I approach trading. The hero's journey narrative teaches you to think of trading as a story with a climax. You're working toward the moment where you call the crash, nail the bottom, make the trade that proves you're brilliant. But professional trading doesn't work that way. There's no climax. There's no moment where you've made it and can coast. You just keep executing your process day after day, extracting your edge when it's there, managing risk when it's not. The traders who make it long-term aren't the ones trying to be remembered for one great call. They're the ones building a repeatable system that generates consistent profits year after year. That's not movie material, but movies don't pay your bills. When I was starting out, I kept waiting for the trade that would finally make me feel like a real trader. The massive winner that would prove I knew what I was doing. And you know what? I had a few of those trades. They felt great for about 48 hours. Then I was the same person with the same skill level, just with a slightly bigger account. What actually made me feel different was developing trust in my process, hitting my 100th trade following my rules, making it through my first serious drawdown without abandoning my strategy, looking back at 6 months of data and seeing that my edge actually expresses itself just like I expected it to. That's not dramatic, but it's real confidence built on real evidence that can't be shaken by one bad trade or one bad week. So here's what I want you to take away from this. You don't need to be Michael Burry. You don't need to call the crash or make the generational trade or have the conviction to bet everything on one idea. Those stories are incredible, but they're terrible role models for 99.9% of traders. What you need is a simple process that you can execute consistently, a setup you understand, risk management that keeps you in the game even when you're wrong repeatedly, a journal that tracks whether you're following your rules, and the patience to let your edge express itself over hundreds of trades. The math is on your side if you do this. A small edge, properly sized, consistently executed, compounds into returns that will change your life over years. But you have to be willing to be bored. You have to be okay with making 2 to 3% per month instead of trying to make 100% per week. You have to accept that your trading career will not make for a good movie. And honestly, that's harder than making the hero play. Taking a huge gamble is exciting. Sitting on your hands, waiting for your setup on a random Tuesday when nothing is happening, that takes discipline that most people don't have. But it's the kind of discipline that actually pays off. Start small. Risk small. Trade your setup and only your setup. Keep records. Trust the process. And remember, boring consistency built every successful trading career you've never heard of because they weren't interesting enough to write articles about. Be one of those traders. The ones who are still here in 10 years, quietly profitable, living their lives, not because they were heroes, but because they were consistent.